Palantir is one of the most valuable companies in the world, worth nearly $350 billion. They have a prestigious client list ranging from government agencies like the CIA and the US Army to Fortune 500 giants like JP Morgan and Ferrari. But almost nobody can explain what Palantir's software actually does, or how they went from an unprofitable CIA contractor to one of Wall Street's software darlings. Today, we're breaking it all down: their unusual founder, the 3 key phases of their business, their product suite and what each piece actually does, and how all of it bakes into the company's epic valuation today. This is Boardroom Wire. Let's jump into it. To understand Palantir, you have to start with the most unusual founder in American business, Alex Karp. Karp is extremely unique as far as Silicon Valley founders go. He isn't technical, doesn't have a business degree, and his resume lends itself more to philosophy than entrepreneurship. Karp grew up in Philadelphia, born into an activist family focused on things like civil rights marches and anti-war protests. He was also severely dyslexic, something he called the formative experience of his life and the thing that made his brain, in his own words, wired differently. Despite the dyslexia, Karp was an excellent student, and he went to Stanford for law school, which he later described as the worst 3 years of his adult life. But Stanford is where the whole Palantir story actually begins, because that's where he met a libertarian law student named Peter Thiel. Karp called himself a socialist. Thiel was a free market capitalist. They argued constantly, and in Karp's words, they debated like feral animals. But despite all of that, they formed a friendship that would prove instrumental to the founding of Palantir. After law school, Karp didn't go into tech. He moved to Germany and continued his education, earning a PhD in social theory at Frankfurt, studying how human beings behave inside large systems, and writing his dissertation on how aggression spreads through language. After completing his PhD, he then started a small money management firm in London. His goal at the time was, in his words, to make enough money to spend the rest of his life reading and writing as, quote, a dilettante. Then, in 2004, Peter Thiel called. Thiel was still early in what would become a legendary investing and entrepreneurial career. Fresh off of selling PayPal to eBay for $1.5 billion, he had an idea for a new company. He believed that the same software PayPal used to catch fraudsters could be repurposed to catch terrorists. The US government had just lived through 9/11 and the intelligence failures that came with it, and Thiel's bet was that software could fix that. But Thiel needed someone to run it. Not an engineer, engineers he could hire. He needed someone who could sit across from a CIA officer or a 4-star general and earn their trust. Someone who understood how institutions actually think. So he called the one person he'd been arguing with for a decade. Karp had no technology background, no defense background, and no company building experience at all. What he had was a philosopher's understanding of how power and institutions work, and the willingness to spend years inside the most secretive corners of the US government doing work most of Silicon Valley wouldn't touch. That combination, Thiel's capital and conviction with Karp's ability to embed inside institutions nobody else understood, became Palantir. And to understand why it worked, you have to understand the problem they walked into. Because in 2004, the US government had a data problem that was about to define the next 20 years of national security. To understand Palantir, you really need to understand that Palantir's business has been through 3 main phases that defined its trajectory. And the first, the government phase, is what formed their core business and technology. In 2004, the US government had a data problem, and it had just cost the country dearly. The 9/11 Commission, set up to investigate the attacks on the World Trade Center in 2001, came to a now famous conclusion. The intelligence community had actually collected the warning signs in advance. The CIA, FBI, and NSA all had intelligence deemed relevant to the upcoming attack, but none of those agencies could connect what they already had. The information existed, but it was siloed in separate systems that couldn't talk to each other. This wasn't a one-off failure. It was how government technology had been built for decades, and it was the direct result of who was building it. For 30 years, a handful of massive contractors had dominated federal IT. Companies like SAIC, Booz Allen, CACI, and the IT divisions of defense giants like Lockheed. The way they worked was simple. An agency would describe what it wanted, and the contractor would build a custom system from scratch, billing by the hour for years. The incentives were totally backwards. Because they billed by the hour, there was no reward for finishing quickly, and no penalty for running over. The longer a project took, the more money the contractor made. So projects dragged on for years, ran wildly over budget, and frequently they didn't work at all. The most infamous example of this failed system came in 2005. The FBI scrapped a case management system called Virtual Case File after spending $170 million. The contractor, SAIC, had been paid for 4 years, but the system never ended up getting launched. The technology and engineering expertise was there to execute on the project, but the incentives were completely misaligned. Now, this is the world that Palantir was walking into, and their idea was structurally different from anything the federal IT industry had ever done. That initial product that Palantir built was called Gotham. What Gotham did was deceptively simple to describe. It took data from completely different sources, phone records, financial transactions, surveillance reports, watch lists, and organized it as real-world objects rather than rows in a spreadsheet. It then mapped the relationships across all those objects, the people, the phone numbers, the bank accounts, and created a unified way to view across everything. So instead of an analyst manually cross-referencing a dozen separate databases, they could pull up a single person and instantly see everything connected to them. Every transaction, every known associate, every location, across agencies that previously couldn't share a thing. This was the exact problem the 9/11 Commission had identified, solved in software. But Palantir had a credibility problem. They were a tiny Silicon Valley startup trying to sell to the most secretive agencies on Earth. No venture capital firm would touch them. The defense industry was extremely taboo in Silicon Valley at the time, and the entire VC industry passed as a result. Since they couldn't raise capital from VC, Peter Thiel funded the company himself in the early years before they found some highly strategic capital. The unlock came from an unlikely investor, In-Q-Tel, the CIA's own venture capital arm. The amount was small, all things considered, around $2 million, but the money wasn't really the point. The signal that the In-Q-Tel investment sent to the market was critical. The CIA had effectively vouched for Palantir, and once the CIA was a customer, the rest of the intelligence community followed. By the early 2010s, Gotham was embedded across US defense and intelligence, reportedly used in counterterrorism operations on the battlefield in Iraq and Afghanistan, and according to several accounts, in the operation that located Osama bin Laden. Palantir has never confirmed that last one, but they've also never denied it. For roughly a decade, this was Palantir, a secretive, government-focused data company with one core product and a client list it couldn't talk about. It was a real business, but it had a ceiling. And around 2015, CART made a decision to break through it by taking Palantir someone no one expected, the Fortune 500. The second phase of Palantir's business was the enterprise phase, and it nearly broke the company before it worked. By 2015, Palantir had a problem hiding inside its success. The government business was robust, but it was capped. There are only so many three-letter agencies and only so many defense budgets to go after. If Palantir wanted to become a generational company, the kind worth hundreds of billions, it had to win in the private sector, the Fortune 500. And the Fortune 500 had its own version of the broken machine the three-letter agencies faced. Virtually every enterprise on Earth had the same problem the CIA had in 2004. Their data was a mess. Enterprises were becoming more and more complex and were drowning in a patchwork of siloed systems. Data was becoming a competitive differentiator, but virtually none of the Fortune 500 had the expertise to connect it all and actually transform their business. Many enterprises took to the big consulting firms to help fix it. Accenture, Deloitte, McKinsey, IBM, and their model was almost identical to the federal IT contractors. They'd send in armies of consultants, bill by the hour, and run multi-year digital transformation projects that cost hundreds of millions of dollars. And by the consulting industry's own numbers, those projects failed most of the time. Studies consistently put the failure rate of large digital transformations around 70%. Companies were spending a fortune to fix their data and getting almost nothing to show for it. Palantir's pitch was the same structural idea that won them the government, but pointed it at corporations. Don't hire an army of consultants to build your custom system that fails. License our platform and we'll connect all your data in one place. The product they built for this was called Foundry. Foundry took the same core idea as Gotham, organizing messy data into clean, connected real-world objects, and aimed it at business problems instead of intelligence problems. A manufacturer could model its entire supply chain. An airline could model every aircraft, route, and maintenance schedule. A hospital network could model patients, beds, and staff. One unified picture instead of a dozen disconnected systems. And the customers Foundry attracted were exactly the names you'd want. Airbus, BP, Morgan Stanley, Ferrari. Serious, complex global businesses with serious data problems. The pivot sounded like it was working like a charm, but the reality is, for years, it barely worked as a business. Palantir went public in 2020 at a valuation of around $16 billion. And for the first couple of years, the stock languished. Palantir was a complex business, and Wall Street did not understand the company. Their contracts were big but lumpy, and the sales cycles were brutally long, counted in months and years versus weeks for many comparable SaaS providers. Part of the reason was how Palantir actually deployed. Their approach was unusual. They embedded their own engineers, they called them forward-deployed engineers, directly inside the customer, sometimes for months, building the platform around how that specific business actually worked. It's a big part of why Foundry succeeded where armies of consultants had failed. But to skeptics, it also looks suspiciously like the very consulting model Palantir claimed to be replacing. A critique that would follow the company for years and one we'll come back to. For a while, the bears had a point. Palantir was growing, but slowly. It was a government company that had bolted on a commercial business, and the market wasn't sure the commercial side would ever truly scale. But then, in 2023, something happened that changed everything. Not just for Palantir, but for the entire software industry. And it turned Palantir from a slow-moving data company into one of the best-performing stocks in the world. Phase 3 was the artificial intelligence phase for Palantir. And it's the reason you're hearing about Palantir as a company at all. In late 2022, ChatGPT launched and set off one of the biggest technology gold rushes in a generation. Suddenly, every company on Earth wanted AI. Boards were demanding it, CEOs were promising it, but almost immediately enterprises ran into a wall. And that wall is the most important thing to understand about why Palantir exploded. The large language models, ChatGPT, Claude, Gemini, were incredible at general knowledge, but they knew nothing about your specific business. They didn't know your customers, your inventory, your supply chain, or your contracts. So when companies tried to actually deploy AI into their operations, it didn't work. The models would hallucinate, they'd give confident answers based on nothing, and there was no connection between the powerful AI model and the company's real-world data. The industry even had a name for it: pilot purgatory. Surveys found that the overwhelming majority of corporate AI projects never made it out of the testing phase. Companies were spending millions of dollars on AI, but couldn't actually get it into production. And this is where Palantir had a decade-long head start that nobody saw coming. Remember what Foundry actually did. It organized a company's messy data into clean, connected, real-world objects. That meant that Palantir had already solved the exact problem the AI models were missing. They had spent 10 years building the structured data layer that an AI model needs to actually be useful inside a business. So in 2023, Palantir launched a new product called AIP, the Artificial Intelligence Platform. And what AIP did was connect those powerful language models directly to a company's real data through the structure Palantir had already built. AIP gave the models the context and the tools to supercharge a business. The LLMs can now answer questions grounded in real data, But importantly, Palantir's connected ecosystem became a framework for AI to actually take action and run operations inside an enterprise. And the way Palantir sold it was just as important as the product. Instead of long sales cycles and slide decks, they ran what they called boot camps. Essentially, they took the forward deployed model from the enterprise years and compressed it into a single week. Palantir's engineers came into your office on a Monday, and by Friday, you'd have a working AI use case running on live data. It was the perfect strategy to combat the AI pilot problem and to satisfy the C-suite's push to get AI into production. Prospects went from skeptical to signing contracts in a matter of days because they'd already seen it work. The results showed up in the numbers fast. Existing customers exploded their spending with Palantir. One company went from a few $1,000,000 to tens of millions of dollars. Commercial revenue, the part of the business Wall Street had doubted for years, started growing more than 100% year over year. US commercial revenue, the clearest sign the Fortune 500 was finally buying, grew 137% year over year in the fourth quarter of 2025. And the stock followed. From its low near $6 in 2022, Palantir ran past $190 by the end of 2025, a gain of more than 3,000% in 3 years and the best performing stock in the entire S&P 500 in 2024. Palantir had gone from a misunderstood government contractor to one of the most valuable software companies in the world. Those three phases, the government, enterprise, and AI phase, each built on the last, and each was highly accretive. Had they not cut their teeth on the government's complex data challenge, they wouldn't have been ready for the enterprise. And if they hadn't pivoted into enterprise, they wouldn't have been positioned to capitalize on the AI wave. But it wasn't just good strategy and timing. Palantir's growth was built on highly technical, deeply integrated product stack with one key innovation that separated them from everyone else in the market. So let's lay out Palantir's product suite cleanly and talk about what makes it so unique. You've already met 3 of the core products: Gotham, the original platform built for government and intelligence; Foundry, the same idea aimed at the commercial enterprise; and AIP, the layer that connects modern AI models to a company's real data. The fourth product is lesser known but equally important: Apollo. Apollo is the unglamorous plumbing that makes everything else possible. It's the software that actually delivers and updates Palantir's platforms wherever they need to run. And Palantir runs in some of the most difficult environments on Earth. Whether it's a classified government network with no internet connection, a Navy submarine, a factory floor, or a commercial cloud, Apollo handles the secure delivery of software across all of it. It's a huge part of why the Palantir team can serve both the CIA and a car company off the same core technology. So that's Palantir's product suite: Gotham, Foundry, AIP, and Apollo. But here's the thing. They're not really 4 separate products at all. Underneath every one of them is a single innovation, and that innovation is the actual reason Palantir's software is unique. It's called the ontology. Simply put, the ontology is Palantir's digital model of how an organization actually works. Not just its data, but what that data means and how everything connects. It lets Palantir build what's essentially a digital twin of a client's entire business. Every piece of relevant data and every workflow mapped to its digital equivalent inside the platform. Take one of those clients like Ferrari. A Formula One team is drowning in data from completely different worlds. There's aerodynamic wind tunnel data, there's track and lap timing data, there's live telemetry streaming off hundreds of sensors on the car during a race, tire temperatures, fuel load, engine performance. Normally, all of that lives in separate systems that don't talk to each other. The ontology pulls it all into a single connected model, a digital twin of the car, the track, and the race. And once you have that, you can do something powerful. You can simulate. You can ask what happens if you pit 2 laps earlier or run a different tire compound, or how the car behaves in conditions it hasn't even raced in yet, because the software understands how all the pieces actually relate to one another. Now take that exact same idea and point it at a giant enterprise. Instead of a race car, picture global supply chains. Most companies store their information in thousands of disconnected tables and spreadsheets. The ontology fixes this. It turns all of that raw data into a living model of the real business: customers, orders, trucks, factories, employees, and the relationships between them. The software finally understands that this customer is waiting on that order, which is sitting on this delayed truck. And here's why that's so critical in the AI era. An AI model on its own is brilliant but blind. It doesn't know anything about your business. Plug that same model into the ontology, and now it can reason about your actual operations. It knows what everything is, what it's connected to, and what it's allowed to do about it. That's the difference between an AI that gives you a clever paragraph and an AI that can actually reroute the delayed truck. This is what Palantir means when its executives say the real value isn't the AI model, it's the ontology underneath it. Models are becoming a commodity. Every few months, there's a new one cheaper than the last. The hard part, the part that takes years and that competitors can't easily copy, is the structured model of the business that the AI plugs into. Palantir spent a decade building that before anyone else realized they needed it. And it creates an incredibly powerful business dynamic. Once a company builds its operations on top of Palantir's ontology, it becomes nearly impossible to rip it out. The platform isn't a tool sitting off to the side, it becomes the operating system that the business actually runs on. That makes it incredibly sticky once it's deployed inside an organization. And you can see that stickiness directly in the numbers. Palantir's existing customers don't just stick around, they consistently, dramatically expand their spending year after year. The more of the business that gets modeled in the ontology, the more valuable and more entrenched the platform becomes. That's ultimately Palantir's flywheel and what makes their product so unique. But a remarkable product doesn't fully explain a $350 billion valuation. To understand that, you have to look at the actual numbers. How fast this business is growing, how profitable it's becoming, and whether any of it justifies the ultra-premium valuation Palantir has received. To fully appreciate Palantir, you have to look at the actual numbers, and they tell two stories at once. To start, by almost every operating measure, this is one of the best software businesses ever built. In 2025, Palantir did $4.5 billion in revenue, growing 56% year over year. That alone would be remarkable at their size, but it's also accelerating. Fourth quarter revenue grew 70%, the fastest growth rate in the company's history as a public company. And then their first quarter of 2026 grew 85%. That was the 11th quarter in a row of accelerating growth. This trend is extremely unusual. Most companies decelerate as they get bigger. It's basic math. The larger the base, the harder it is to grow. Palantir is doing the opposite. It's getting bigger and growing faster at the same time. The engine behind its growth is US commercial, the Fortune 500 businesses that Wall Street doubted for years. It grew 137% year over year last quarter, bringing Palantir's total US commercial customer count to around 570. And while that growth sounds impressive, that level of penetration is actually quite low. There are still thousands of firms Palantir hasn't sold into yet, and their runway here is truly enormous. Now layer on the profitability, because this is what separates Palantir from almost every other high-growth software company. Gross margins are around 80% and adjusted operating margins are around 75%. That's what really separates Palantir from almost any other high-growth software business. It's not actually burning cash to grow, it's growing profitably. There's a single metric that captures this. It's called the Rule of 40. You add a software company's growth rate to its profit margin, and anything over 40 is considered healthy. 40 is the benchmark for a great software business. Palantir's Rule of 40 score is 127. It's more than 3 times the benchmark and one of the highest scores ever recorded in enterprise software. By the operating numbers, there's simply no other enterprise software company that's competing with Palantir on these metrics. Now, here's the flip side. There are some very prominent investors who have made valid critiques of Palantir's business. In late 2025, the most famous short seller of the modern era took a position against Palantir. Michael Burry, the investor played by Christian Bale in The Big Short and the man who called the 2008 housing collapse, disclosed put options on around 5 million Palantir shares, a bet worth roughly $912 million. Then he laid out his case in a 10,000-word essay he called Palantir's New Clothes. His estimated fair value for the stock was $46, implying a collapse of around 65% from where it trades today. His argument comes down to three things. First, the valuation. Palantir trades at roughly 65 times its sales. Most elite software companies trade between 10 and 20. Palantir is in a category almost by itself. In 2025, the company beat expectations every single quarter, and in 2026, the stock still fell more than 20%. The business keeps exceeding every target, but when a stock is priced for perfection, good isn't good enough. You have to be flawless, and any stumble gets punished violently. The second is the consulting critique. This is the one that's followed Palantir for years. Remember those forward deployed engineers? The Palantir staff embedded inside customers for months at a time? Burry's argument is that this makes Palantir less scalable software company and more a high-end consulting firm in software clothing. Labor intensive, hard to grow, and not deserving of a true software multiple. Though it's worth noting, with gross margins around 80%, that critique is a lot weaker than it used to be. And the third critique, and this one is the one that's actually been moving the stock, is competition. In April of 2026, Burry posted that Anthropic, the maker of Claude, was eating Palantir's lunch in enterprise AI. He cited data showing Anthropic capturing 73% of all new enterprise AI spending, and he drew a brutal contrast. Anthropic has grown from $9 billion to $30 billion in an annual revenue in a matter of months, while it took Palantir 20 years to reach $5 billion. The argument is simple. Cheaper, simpler, off-the-shelf AI is becoming good enough for most companies, and Palantir's complex high-touch platform might be overkill. When Burry posted it, Palantir lost $23 billion in market value in a single day. So that's the overall bear case, and it's a serious one. But here's the thing. Palantir's growth is so strong it may not even matter, because Palantir is quietly growing into its own astronomical valuation. Even if Palantir's growth slowed to 40% a year, roughly half of what it's doing right now, its revenue would still more than quadruple to around $30 billion by 2030. At that level of revenue, today's valuation would represent about a 12 times sales multiple. Still a premium, but an ordinary one for elite software businesses. In other words, the company may not be overvalued so much as priced 3 to 4 years ahead of itself. And if it could somehow sustain this pace for a decade, Palantir's revenue would approach the scale of Microsoft's entire business by the mid-2030s. That's an enormous if, but it's the bet that the market is making. So what has to be true for the Palantir bulls to be right? The US commercial adoption has to keep compounding. The ontology has to stay the thing competitors can't replicate, and Palantir has to keep converting that decade-long head start into customers faster than AI labs can catch up. For the bears to be right, if growth slows even a little, the multiple collapses, and a great company turns out to have been a bad stock. What's not in question anymore is the business. Palantir has spent 17 years being misunderstood, unprofitable, and doubted. It's now one of the fastest growing, most profitable software companies on the planet. The only real debate left is the price. So that's Palantir, a company that spent its first decade in the shadows of the intelligence world, its second decade convincing corporate America it wasn't just a contractor, and its third decade becoming one of the most valuable and most debated software companies on Earth. What it actually does is no longer a mystery. It builds the operating system that lets the world's most complex organizations make sense of their own data, and now act on it with AI. Whether that's worth $350 billion is the question the market will spend the next few years answering. If you found this breakdown helpful, leave a like, drop a comment, subscribe. With that, This is Boardroom Wire. See you on the next one.